Welcome to today's webcast, Complex Assets, Risks to Insurers and How to Evaluate Them. Before we begin, I'd like to cover a few housekeeping items. To receive a copy of today's presentation, please send a request to reply@rrc@riskreg.com. To ask a question during the meeting, type your inquiry into the Q&A panel to the right of your screen. We will respond to all questions after the session unless time permits at the end of the session. To answer polling questions, click on the radio button to the left of your desired response, then click Submit to record your response. For technical assistance, click the Help widget at the bottom of your screen. Today's presentation will be recorded. Log into the webcast with your first and last name and email address. Remain on the webcast for a minimum of 50 minutes. Participate in polling questions, 80% response required. To answer the polling questions, click on the radio button to the left of your desired response, then click Submit to answer your question. You do not need to have the correct answer, but you must participate to receive credit. Complete the course participation survey at the end of the webcast. For attendees participating in the group, designate one proctor to log in as an individual on behalf of the group, then complete and submit the group sign-in form within 24 hours of the event conclusion. The form can be downloaded from the resource list to the right of your screen. Complete and submit the course participation survey. The form can be accessed from the resource list to the right of your screen. One CRE credit will be issued to eligible participants within 30 days. RRC will not issue credit if all criteria are not met without exception. It is now my pleasure to turn the call over to Tricia Matson. Tricia, the floor is yours.
Great. Thank you so much, Allison. So I'm Tricia Matson. I'm a partner here at RRC, and my background is as a life and health actuary. I have been involved in a number of reviews that touched on the topic of complex assets, and as you'll be able to tell from some of my remarks, my focus tends to be on how those complex assets then interact with the liability side of the balance sheet, and how companies look at implications, for example, on the adequacy of the assets to support their reserve obligations. And I will turn it over to Ed to give an introduction.
Okay, thanks, Tricia. I'm Ed Toy. I've been with RRC for just a little over 4 years now. Prior to that, I was with the NEIC, most of that as director of the Capital Markets Bureau for about 10 years. And before that, I was an investment manager, portfolio manager, investment analyst, trading desk, all the sorts of fun stuff. And I've been involved in insurance regulation since 1993. So that's a brief introduction. And I'm responsible for the first polling question that Allison mentioned. And the question is, what is your level of familiarity with today's topic? And there are 4 possible answers: very familiar, somewhat familiar, not very familiar, and no idea at all.
Okay, looks like we have a pretty good response rate here.
We're up around 80%, so I think we can move on.
And don't forget to hit submit, people. we know everyone wants their CE. Okay, we have no one that's completely unfamiliar, so that's good. All right, so I know we don't have a ton of time for our materials here, so I'm going to move us along here. Some of the things we're going to talk about, I'm going to start actually with a little bit of why we have seen the phenomenon of increasing complexity in the asset portfolio. And then I'm going to turn it over to Ed. He's going to talk about what these assets look like, some of the risks that are associated with the assets that we need to think about as we're looking at company solvency. I'm going to touch on some of the activities at the NEIC related to complex assets, and then we'll kind of close with some considerations in terms of how we might want to address these risks as we're looking to policyholder protection. So we've got another polling question here. So folks can chime in here and let us know what your current role is: actuary, analyst, examiner, or other. And don't forget to hit submit. Okay, and maybe it's me, but I'm seeing no one answering. Oh, there we go. It finally went. I don't want to go too fast because I want people to be able to get their CE. So looks like we're getting close here. All right, I'll just give it another second. Put in your answer and hit submit if you haven't already. All right. Okay, so pretty mixed audience, which is good. And let's see. So again, starting with some of the background on this topic, this slide here is showing information that is probably not shocking to most of you. So on the upper left, we're just seeing the information in terms of the interest rate environment. So obviously now we have some different phenomenon happening in 2022, but we have had for the past many years declining interest rates, which certainly has put pressure on life insurers in terms of their ability to maintain adequate yields. And I should just mention that because this complex asset issue tends to be more prevalent in the life insurance industry, a lot of our comments do relate to life insurers, but that does not mean that this phenomenon is exclusive to life insurers. So a lot of these same characteristics carry over. It's just that, of course, life insurers tend to have much longer dated liabilities. And so they tend to have more exposure to some of these risks. And so then what you see on the bottom half of the page here is a chart that shows the spread between earned rates and credited rates. And so over time, again, probably not anything surprising here, there's been a lot of pressure on profitability because of those narrowing spreads for life insurers. And that's a graph that the NAIC puts together using annual statement data. It's an estimate, and it uses data from about 550 life insurers. And then in this next page, we see some data related to surrender activity. This report actually now is based on 763 filers in 2021. And so what you can see here, there's been increased exposure to surrenders. And that we may actually see now continue with the rise in rates. We may see more customers looking to find higher credited rates elsewhere. So with some of that happening environmentally and, maybe to some degree outside the control of the life insurers, what we're seeing on this next slide is some changes in the mix of assets. Now, this page is across the entire insurance industry. It's not life insurance specific, but we have seen a gradual move into more real estate, equity, and scheduled BA assets. In part, I mean, we don't have, very specific evidence that it's 100% because of the environment, but, certainly in part as a way to offset the declining investment returns. And if you have situations where liabilities are relatively long and, you can kind of buy and hold, some of the risk, short-term volatility risk, for example, may not be super impactful on the insurance company. So it can be a good strategy as long as the risk is well managed. And then the next slide here has some additional statistics in terms of the asset portfolio. So you can see on the left that even within the bond category, there's been an increase in exposure to corporate as compared to government. And then you see on the right-hand side, those three lines are for life, P&C, and health insurers respectively. We see an increasing allocation to private investments, private bonds. And again, if you can buy and hold it, private bonds certainly is going to help in terms of that spread compression and those lower yields. There's a lot of things that go into these investment decisions. There's other things insurers are considering. The search for higher returns may not entirely explain this shift, but it's certainly an important component. Okay, so then on this next slide, this one is life insurer specific. And so we can see here, nothing dramatic, but a gradual over time move into a lower quality mix on the asset portfolio. So, gradually shifting away from NAIC 1 into more NAIC 2 and some additional allocation even to categories below NAIC 2. And then this next slide has some data from FIO's May 2022 Financial Stability Report. That's an annual report related to the insurance industry. And the top half of the chart shows information both for life and P&C insurers. But you can see, both of those dotted lines, both life and P&C, we see some increases in investment in less liquid securities. So in particular, more investment in ABS, commercial real estate, alternatives, and illiquid corporate debt. And so the bars there are the dollars. And obviously, you have growth in assets overall. So those are notably rising. But the lines that you see, the two dotted lines, actually show the percentage of the total portfolio. So even there, we do see an increase in more kind of complex assets, so to speak. The chart on the bottom actually points to the liquidity profile on the liability side. So there, higher, if we have lower liquidity on our assets and then higher liquidity, in other words, more demand deposit on the liability side, it's kind of a double whammy. And so that's what we see, that there's increasing liquidity of the liabilities because of things like repos, sec lending, federal home loan bank advances, and funding agreement backed securities. And then probably also no surprise here, one driver of these more complex and less liquid securities is the increasing involvement of private equity in the insurance industry. So because, again, of this nature of the liabilities where they can be kind of sticky liabilities and, you can tend to invest in maybe, less liquid or more complex securities, there's been a lot of interest in that from private equity. So on the upper left here, we see data from a AM Best report updated through July 2022. And so that showed that PE insurers, private equity insurers, or private equity owned insurers, the total admitted assets grew to $850 billion at year end 2021. And then they also reported that the PE insurers accounted for nearly 20% of annuity reserves and over 33% of indexed annuity reserves. In other words, those are kind of higher target types of liabilities that PE owned insurers have that private equity is interested in investing in terms of the life insurers products. And then that chart on the bottom is showing us that the makeup of the bonds for private equity owned insurers tends to include significantly more allocation to asset-backed and other structured securities, but not so much in terms of additional exposure to below investment grade. The other thing I just did want to point out is that the data that AM Best has on private equity ownership does not include offshore. So I think if you added some of the offshore assets into this chart, it would be an even more significant phenomenon. So in light of all this that's happening out there, there's been a lot of NAIC activity going back, 1 year from now. Last December, the NAIC had put together considerations that were applicable but not exclusive to PE-owned insurers. And so we've got a list here. I'm going to go through some of these items that's been an area of focus, and a lot of which has resulted in additional requirements and activity. And I'll talk a little bit about that as well. So this list was put together as kind of an initial list of potential regulatory concern areas. And the conclusion around this was that although private equity involvement may have led to these issues kind of bubbling up to the surface, that any modifications made to regulatory guidance should apply to all insurers that have these same characteristics, either more complex assets or some of the other items you see here, affiliated agreements, changes in control. So there's been a lot of activity led by the macroprudential work group, as well as its parent, the Financial Stability Task Force. And then just to maybe touch on a few of these. So again, the focus of our discussion today is on the complex assets, but some of the other things that have been raised relate to, again, affiliated party agreements that either aren't transparent, aren't following arm's length considerations, ways that companies exert control or new owners may exert control over an entity other than through ownership. So for example, board makeup. Terms of investment management agreements and making sure those reflect fair provisions, that they're arm's length, and over focus on short-term results versus kind of long-term policyholder protection. And then issues around like operational governance, market conduct, whether the new owners or the board have appropriate insurance expertise in order to make sure that that policyholder protection element is there. And then the next page lists out some additional considerations. The one at the top there, again, I think it was concluded that because these items aren't necessarily specific to private equity, that a uniform definition may not even be necessary. But I think what we now will see coming out of these considerations is some new requirements. So for example, disclosures that have to be included in Form A filings, more disclosure around control, elements of control beyond just percentage ownership, additional requirements, for example, around risk-based capital, asset adequacy, requirements or standards for the investment management agreements between insurance companies and their affiliated asset managers, and then perhaps new standards related to maximum interest rates on surplus notes that are issued by insurance companies. So there's a whole host of activity underway at the NAIC. One in particular that I will touch on that is effective this year end is a new actuarial guideline. So again, my focus on this topic tends to be on what happens with reserves if you have a lot more risk in your asset portfolio. And so there will be additional requirements for this year end that require allocation of any excess yield over a defined benchmark to the risk that's giving rise to that excess yield. So what proportion of that is associated with default, what proportion is associated with liquidity, et cetera. And then sensitivity testing, kind of using more of a normal yield level in the event that there is a large proportion of high yielding assets in the portfolios. Again, it's the first year for this, but I'm sure we're going to get a lot of additional useful information from these filings. So let's see the implications on this. What does this mean for all of us? So I definitely see this more broadly than just private equity insurers. I would add that it is certainly dependent on the nature of the liabilities. So again, I think when a lot of exposure to lower interest rates, there's guarantees or they were priced assuming yields would be much higher, putting pressure on profitability, combined with the liabilities are a little bit more sticky. So I mentioned the interest private equity tends to have in annuities. I've seen some of this activity on long-term care as well because of the characteristics of a long-term care portfolio. And so those additional investment risks obviously give us kind of a red flag in terms of prospective solvency. If there's higher default risk, higher concentration in affiliated parties, or if it's very hard to sell these assets when cash is needed, it obviously could cause problems in terms of prospective solvency. And again, we're going to hear from Ed in a minute about the characteristics of each of these asset classes. And then beyond kind of just looking at solvency, are the reserves adequate? Is there default risk? I think it also has to be considered by the company in their own ALM, in their own in-force product management, their crediting rate strategies, their pricing, and then of course, enterprise risk management. So it's just really important for us all to understand what these assets are and what some of the risks are. And so with that, I'll turn it over to Ed.
Thanks, Tricia. And before I actually start touching on these bullet points on this slide, I did want to emphasize one point that Tricia had made earlier, and that is the issue or the potential concern here is not just specific to insurance companies that are owned by private equity funds and private equity fund managers. There are a lot of different reasons why the insurance company investment portfolio, especially for life companies, but also to some degree for P&C and health companies, have changed over the years. Some of it is obviously it is driven by the ownership structures. Some of it is driven clearly by the relatively low interest rate environment that existed from 2008 until really this year. And this year, it's yields are not that much higher, but they are higher. And then there's just an overall change in the marketplace. So when I think in terms of now looking at this particular slide, what do we think of as being the traditional assets of insurance companies? If there is a possible way of thinking of traditional assets, I say frequently, when I started in this business way too many years ago, the typical life insurance company portfolio was 25, 30% investment grade utility bonds. And that world just simply does not exist anymore. Even if an insurance company wanted to have that, it's just not possible. But thinking in terms of what we like to think of being traditional assets, issuer obligations, primarily corporate bonds, and of corporate bonds, the sweet spot for insurance companies have been mainly single A and triple B rated bonds. A lot of government bonds, maybe more so on the P&C and the health side, but not an insignificant holding of government bonds on the life side as well. Issuer obligations represented the vast majority of insurance company portfolios. Second, a significant exposure to common stock. That exposure mostly on the P&C side and mostly with the larger P&C companies, but the common stock or the equity exposure was generally speaking exchange traded large cap equities. That you could really, there was a lot of transparency in terms of the pricing and in terms of the volatility. A decent sized exposure to mortgage loans. Mortgage loans primarily on the life insurance side, virtually zero on the P&C on the health side. And for the mortgage loan portfolio, it was commercial mortgage loans, almost exclusively first lien mortgages, loan to values of 65% or lower, debt service coverage ratios of 2.5 times on 30-year amortizing mortgages, commercial real estate properties. That was that's what we like. At least a few years ago, I thought of this is what insurance companies own. The characteristics of that kind of portfolio, what do we usually expect for issuer obligations and mortgage loans? We have a fixed maturity date, most likely having amortization payments, so it wasn't all due at maturity. There was, again, if we think in terms of commercial mortgage loans, it was fully amortizing loans. So by the time you got to the maturity, there was a relatively small bullet payment, so to speak, at the end. Coupon payments that were almost entirely fixed rate, and to the extent that there were some non-fixed rate holdings, the floating rate or adjustable rate was tied to a typical interest rate index. So the 1-year Treasury, the 3-month LIBOR, something that, again, easily benchmarked, we could tell, without too much difficulty, if interest rates are rising, what should happen with the interest rate on that particular adjustable rate or floating rate investment. Again, on the common stock side, very liquid investments, and those liquid investments could be relatively easily benchmarked to the market and to one of the larger cap markets, primarily the S&P 500, maybe if you want to stretch a little bit to the Russell 3000. So one of the things, again, as we search for yield, whatever the reason might be, and clearly after 10, 12 years of low interest rates following the great financial crisis back in 2008, clearly a lot of investors in general, and that includes insurance companies, really looking for some additional yield, get something above the near zero rates that were on Treasury and government bonds, and not much better than near zero rates on good, high quality investment grade corporates. So, what did investors in general, including insurance companies, what did they do? They stretched a little bit more to private placements, expanding their exposure to non-public securities, although the lion's share of non-publics was still bonds that were tradable under one of the SEC exemptions, Rule 144A or one of the other carve-outs for registration to get a little bit of a premium. That's obviously a fixed number at that point. Possibly going out longer duration. This is going to be primarily, almost exclusively on the life side, going as farther out as they could. And again, for life companies, stretching to 10, 20, possibly 30-year maturities, and therefore getting to that 20 or higher duration number. Also, and this is probably where we're going to be spending more of our time thinking about different return profiles in terms of their fixed income investments. Going to fixed income to some degree, staying with fixed income investments, but looking for those kinds of investments that have higher volatility or potentially higher volatility. And that's a broad generic term to include lower credit quality, more structured kinds of securities, or possibly different kinds of markets, like the emerging markets universe. And even beyond that, to developing markets. Investment portfolios or investment types that have less predictability, and that would be things like structured notes, things like different kinds of structured securities that have different kinds of profiles. And then finally, as far as the sub-bullet here, different kinds of cash flow variability. And that's, when I think in terms of that, that's going to be primarily RMBS, although it does expand and include other kinds of investments as well. So those are kind of like the generic ways of looking for some additional yield. Now, thinking about those different kinds of characteristics and trying to get a little bit more yield, here we dive a little bit into more complex assets, or that generic term of more complex assets. And I think we're also trying a little bit to go beyond that definition of, or that term, complex assets, to, when we think in terms of the work of the Life Actuarial Task Force, any kind of asset that gets a little bit more yield, more yield above that generic triple B kind of quality. And these are the things that come to my mind anyway, not that this is by any means an exclusive or exhaustive list, because there are lots of things beyond this that are smaller ticket items, so to speak, ones and twos, if you want to use that term. But these are kind of the asset classes that we think a little bit of that are, at least as far as generic industry-wide exposures, a little bit broader exposure. Certainly going back into the 90s, one of the areas that the insurance industry expanded into fairly significantly was different kinds of structured securities. That would be, first off, different kinds of residential mortgage-backed securities, RMBS, either agency or non-agency, but also then after the 90s into the 2000s, expansion into CMBS, commercial mortgage-backed securities, and interspersed in all of that time frame. Also, asset-backed securities and asset-backed securities, if you go back to one of the earlier graphs that Tricia focused on, and I think I might have a little bit of a repeat later on, is different kinds of asset backs. That's been kind of like the big growth in the last 10 years or so. One of the areas to focus on in terms of structured securities is the growth in non-agency, and within the growth in non-agency, the expansion of insurance company investments in non-senior tranches. So you think in terms of credit risk anyway, the senior tranches typically come with AAA kinds of or high AA kinds of credit ratings from the rating agencies. But once you get beyond those, then you get into the mezzanine tranches, and beyond the mezzanine tranches are the subordinate tranches. Mezzanine tranches usually having AA kinds of rating agency ratings, and then if you go beyond that to the subordinate tranches below AAs. Next, in terms of expansion, are investments that are reported on Schedule BA. When I think in terms of investments reported on Schedule BA, focus primarily on the unaffiliated investments, because affiliated investments reported on Schedule BA are fairly significant. But then focusing, on the unaffiliated investments on Schedule BA, private equity funds and hedge funds represent the bulk of, at least the majority, 50-60% of unaffiliated investments reported on Schedule BA are private equity funds and hedge funds. The other, less than 50% is a mishmash of all sorts of different things. That includes surplus notes. It includes a lot of different things. One area that I've noted more recently, it's still not a significant number as a percentage of that number, but that asset class, so to speak, but notable in terms of its growth, its growth in the last 10 years or so is collateral loans. Moving on to the next bullet, mortgage loans. Again, I had noted earlier that what we think of in terms of mortgage loans, especially with life companies, is that first lien commercial mortgage loan, 65% LTV. This is more anecdotal, but what I've noticed recently is increasing exposure to construction loans. And I use the term construction loan relatively broadly to not just ground up construction, but also renovation loans, transition loans of all sorts of different types. And again, very anecdotal, but there's clearly an expansion beyond the more typical kinds of investments. And I highlighted it because it's different. And that leads to some additional concerns and some different control issues and management issues. Bank loans, there was a lot of growth in that going back 4 or 5 years ago. That is newly added as far as a blanks reporting disclosure going back, I think, around 2018, 2019. The growth in bank loans, and I hate that term because it's not just bank loans, it's any kind of loan that's reported on Schedule D1, but that growth seems to have leveled off a little bit in the last year or so. Then finally, I do want to highlight, not that it's a significant percentage, but some of the other stuff that we see, and that is mutual funds and exchange-traded funds, and then finally structured notes. And my reason for highlighting those, even though they are not that significant as far as exposure, but worth highlighting because they're very different. And there's not a lot of transparency that we have in the in the annual statements. They can tend to get buried, for mutual funds. They can tend to get buried in mutual funds that are reported on common stock. For structured notes, it's very hard to tell what they are. When we have done a deeper dive and looked for them, it's not a significant exposure, but they're buried in the investments that are reported on Schedule D1 and very hard to find. Turning back to structured securities, I touched on the three generic subcategories of structured securities, but just to highlight a few specific points within residential mortgage-backed securities, thinking in terms of the prepayment variability or the volatility, some of the concerns within RMBS that goes across both agency and non-agency. And if anything, there's a little bit more volatility on the agency side, is different kinds of prepayment scenario variability with CMOs or collateralized mortgage obligations, and that includes the subclass of interest-only securities. That is, fortunately for us, a really, really tiny number, but it was a problematic area in the 90s when there was not a lot of additional disclosure. And there were a lot of insurance companies that bought IOs because they were agency securities and they came with AAA ratings, but that did not reflect the volatility of, the exposure to IOs for RMBS is pretty tiny at this point, but, at least on an industry-wide basis, but it is something worth noting. And it's pretty tiny because there is a bit of an RBC surcharge, so to speak, that I won't go into for this presentation, but it is from an RBC standpoint, it is a kind of an expensive asset class or sub-asset class to own. Within asset-backed securities, just to point out, that's just because we have gotten a lot of attention in recent years with collateralized loan obligations or CLOs and collateralized fund obligations or CFOs. CFOs are a relatively small number at this point, but there's a lot of discussion because they are backed by equity kinds of investments. And so therefore, always a question, how are we looking at that? And is it is it appropriate, or are there additional concerns because we're looking at a debt instrument that is backed by equity? And on the CLO side, there's just been a lot of attention because the underlying assets of CLOs are bank loans, and also there has just been a lot of growth in that area in the last 5-10 years. With growth in the bank loan market, not just among insurance regulators, but among federal regulators, banking regulators as well. I'm thinking that growth might be tailing off some. And if you look at the CLO issuance numbers so far in 2022, it's likely that growth will drop off fairly significantly because just new issue volume of CLOs dropped off fairly significantly this year. Again, to just highlight and repeat those things that are reported on Schedule BA, private equity funds and hedge funds, to drop down to the second and third bullet, those are the majority, the bare majority of unaffiliated investments reported on Schedule BA. I think the primary thing that I get really concerned about when I think about those investments is that they're very, very illiquid. And that's probably the case for everything that we think of in terms of Schedule BA. We should really assume all of those investments to be illiquid, or the liquidity is very marginal. But with respect to private equity funds and hedge funds, there are actually restrictions on sale. The only way to get the cash back is to basically put them back to the fund and the fund managers, and that is obviously potentially very problematic, especially if the market's not doing well. As far as collateral loans, I think we, again, not so much that it's a significant dollar number or percentage of it assets, but just because of the growth in collateral loans and the difficulty in terms of understanding what the collateral loans are. With private equity funds, at least for the most part, we can see that they're the big private equity fund managers, Blackstone, KKR, whoever, Guggenheim, whoever they might be, that they probably, the big names probably represent the bulk of the exposures in the insurance industry. But collateral loans, it's a mishmash of so many different things. And I think it's just a highlight. It is interesting, in my mind anyway, that Statutory Accounting Principles Working Group, SAPWIG, recently exposed, a clarification that the underlying assets have to be admitted as or admissible assets for a collateral loan to qualify as an admitted asset. And I think that's an important clarification. The language that existed already for collateral loans pretty much said that, but maybe didn't say that all that clearly. And I think we'll obviously pay attention to that because I think that will help a lot in terms of our ability to look at collateral loans and understand exactly what they are and what the risk is. Oops, I think I hit the wrong. Structured notes, even though it's a relatively small number, I did want to just highlight here because it is so hard to find, and therefore there are some additional concerns when it comes to structured notes and what we might, I think we should pay attention to it. The first thing is structured notes. The question is, are they principal protected or are they not? Is it really just a matter of the income stream is very unpredictable and very unreliable? It could be tied to almost anything. Or is there actual also risk of loss of principal? And SAPWIG, going back a couple of years now, did decide that if it's not principal protected, following along with a FASB decision on for GAAP purposes, that those should be reported as derivatives. And there was some additional language in the blank to provide for that. So ongoing concern is whether or not even things that are principal protected, should those also be reported on Schedule DB as derivatives, because they could be tied to almost anything. The example I throw out there, not that I ever actually saw an example of this, was it could be tied to gold prices, it could be tied to cryptocurrencies, it could be tied to almost anything. And again, the concern is that volatility and that lack of transparency that we really don't know what it's tied to. But it comes under the moniker of it's issued by Wells Fargo, it's issued by Citibank. But what they are obligated to pay could drop to zero if that index number goes in the wrong direction. Or it could be relatively simple and straightforward, like a simple spread or yield curve steepener. Thinking about equities, again, we like to think of equities as well, that, they at least used to be fairly plain vanilla. Publicly registered securities, we might have had some concern about what exchange it was traded on. And there was actually, going back to the early days when I was getting involved in NEIC things, that there was, some strange exchanges. But now we're seeing more and more private common stock, and then also equities and equity-related things that are reported on Schedule BA, so not publicly registered. Within even publicly registered securities, a lot more that is not the typical large cap. And so therefore thinking in terms of, common stock that has a higher beta. When we think in terms of large cap, S&P 500 kinds of investments, it's got a beta somewhere around 1, a volatility somewhere around 1. But small cap stuff, venture capital stuff, that's going to have a beta of 1.5, a beta of close to 2. And that volatility is just going to be that much higher. And obviously to the degree that we're looking at private stuff, private kinds of equities, those should be seen as higher beta kinds of investments. And so I think that this all drives to additional concern or additional need for vigilance when we think in terms of equity investments. So having gone through those changes in investments, what are some of the considerations for us to think about? Credit quality is certainly first and foremost, although everything that I look at, I don't get too overly concerned about credit quality. Certainly below investment grade numbers are what they are. What is on the cusp in terms of BBB minus and the risk, especially if we go into a recession next year, that we could see downgrades to below investment grade. That's a concern. Different kinds of investments, things like structured securities that have different loss severities. Credit quality, credit ratings are only risk of default. They don't address loss severity. Right, this is loss severity is something that the new investment risk evaluation working group under capital adequacy is taking a look at. But beyond credit quality is also market volatility. When we think in terms of investment grade utility bonds, there's not a lot of market volatility on that stuff. But when we go beyond that standard, that traditional kinds of investment, then we see more market volatility. Structured securities, that market is smaller. Emerging markets, that market is smaller. So when we're dealing with smaller markets, we have to expect that there's going to be more volatility in fair market values. In terms of liquidity, not just private placements, not just true private placements, but that are going to be less liquid. But whenever you have a market that is smaller and that there's more market volatility, that's going to have less liquidity. Cash flow variability is an issue, especially for RMBS and especially for rising interest rates. The cash prepayment rates on RMBS are going to drop dramatically this year and for the foreseeable future because of higher interest rates. And then finally, just volatility and the ability to forecast investment returns. Going back to all the different things that I mentioned before, this is a little bit more defined in terms of some of those issues. On the structured securities issue, we've got over-collateralization triggers for non-senior bonds. Even before losses are even realized on those investments, you get to the point where there might be drop-offs in terms of payments to subordinate tranches. And then finally here is unfunded commitments. That is certainly the case with private equity funds. It is also the case with construction loans that I mentioned earlier, that what are we seeing? What is the insurance company seeing as far as the need to fund commitments going next year, the year after that, the year after that, and how could that impact liquidity and liquidity needs? As far as forecasting investment returns, we've got timing of cash flows and timing of markets. Private equity funds, one of the things I noticed a little while ago was the drop-off in terms of private equity funds and the ability to sell off their investments. And if they can't sell off their investments, they can't distribute to their investors. The unknowables of structured securities, I already touched on that quickly. And then cusping markets and emerging markets, I think I might have a slide on this later, but the returns on that and the market volatility in that and the liquidity on that varies very dramatically. Liquidity issues, I think I touched on all of these things all really quickly, but this is just a highlight on these different issues. The next polling question: are any of the companies you regulate investing in the following types? A, construction loans, B, hedge funds, C, private equity, and then venture capital, none of the above, or I don't know. I'm not seeing any responses yet. Oh, here we go. All right, we're up around 3/4. I think why don't we just move on because we're running short on time here. Private equity, 50%, that's certainly an area of concern and an area where we've got at least a little bit more transparency, so that makes sense. So moving on to the rest, this is just the rest of the slides are just a few, follow-ups, just to note some things that Tricia actually touched on, but this is the highlight, especially, I think for this slide, the green part of the bar is worth noting. That's the growth in non-agency ABS. That's primarily the growth in CLOs. And I mentioned that before as the major area of regulatory attention almost universally, but I'm thinking is going to slow down some in this year and in the coming years. Alternative investments, I think here you see certainly some growth. This is for the entire insurance industry, and it includes that orange bar, which is straight out equities. And I think a lot of that is driven by what had been a very strong equity market. So we'll probably see some drop off there in this year and maybe in the next couple of years. I think it's worth noting that the gray bar is still, it's growing, but it's still not that significant a number. In terms of unaffiliated Schedule BA, it's still less than 4% of industry assets. Just to note, current market kinds of condition issues. The gray line is the current yield curve. That's interesting in that it's an inverted yield curve right now, and that says something in terms of what we might see as far as issues and concerns this year, at the end of this year, as we start looking at year-end kinds of data. And I'm going to just flip through these slides just to note the volatility in spreads, and then we move on to the next polling question, which is, what is your biggest concern regarding complex asset risks? A is significant and widespread defaults, illiquidity and inability to cover cash flow outflows, lack of sufficient capital charges for risk, challenges for stakeholders to understand the risks, concentration risk, all of the above, or I don't know. So we're seeing some answers. Let's see, once we get above half. Oh, here we go. All right, I think we're up around 3/4. So let's just see what the answer is. All of the above. And I think that's probably a perfectly legitimate answer. And then my last slide is the custody market question. When we think about the complex assets, and this is just the one complex asset that I have data for, and you see the volatility here in the gray line in terms of emerging markets relative to high yield. Emerging markets is BBB minus, BB plus, BB kinds of bonds, and you see that differential just in the last year and a half, 2 years, anywhere between 150 basis points and 400 basis points. That's what you're seeing, and I think when we think in terms of complex assets, and again, this just being the example because it's the one place where I can get some data. So I'll turn it back to Tricia.
Thank you. So we've talked a lot about the nature of these assets and the risks. I just wanted to kind of add a little bit of balanced commentary. So this isn't all bad, right? So if a company is investing in assets that are providing higher yields, and they are doing a good job measuring and mitigating the risks, then there are a lot of positives for the policyholder. So if a company earns more, then they can potentially credit more. I mean, the question is, are they? But it could potentially lead to higher credited rates or other non-guaranteed elements like dividends for the customer. If the higher returns are incorporated into pricing analysis, and again, it should be incorporated with appropriate cost, right? With risk comes cost. But in some cases, if the liabilities are sticky, there could be additional return without a lot of additional risk. And if that gets passed through the pricing, it could lower premiums. There also could be, as I mentioned, the increase in non-guaranteed elements. So the combination of those lower premiums or higher non-guaranteed elements could increase competition, which then kind of might spread its way to other carriers in the marketplace. And then I think some of what we're going to see happening in terms of these new regulations will be good because it'll create additional protection against some of these risk areas. And there's another polling question coming. So we promised to get you that last one before we hit the end of the hour. So this next slide just touches on a few things we might want to look at, for example, if we're examining an entity. And I'm just going to comment on the last one because that last one relates to reserve adequacy. So if a company has a significant proportion of these assets in their general account supporting their reserves, things the company might do to mitigate the risk is potentially having independent reviews of the way that they're incorporating asset risk into their projections, have some outside expert look at it. I mean, some of these asset classes are very, very complicated, and it could be hard for an actuary doing asset adequacy testing to understand them all. But certainly they could bring in an outside review or just sensitivity testing some of the risk to understand what it does to the reserve adequacy results, and then considering that and forming an opinion. And then to the extent that there's not a lot of company mitigation in place, maybe ways that we could substantively test this is actually look in detail. And I've done this on examinations, look in detail at what they are assuming for spreads, defaults, borrowing. Do they assume an unlimited amount of borrowing, disinvestment, and just making sure that in setting those assumptions, we don't have a situation where there's much higher spreads because these assets provide higher spreads, but without a commensurate increase in whatever the risk is that's giving rise to those additional spreads. So again, we've done that on our substantive testing already, and we'll continue to do so. And so Ed, I'll let you chime in briefly, and then we'll make sure we get to our last polling question.
Yeah. I mean, just to emphasize what Tricia said, when I think in terms of the investment risk side of the equation, if they're investing in these kinds of things, and it's a spectrum of different kinds of risks, do they have the monitoring and the managing and the risk analysis abilities to be looking at those? And have they ramped up so they understand and are managing that risk? Just as an example, a bad answer, if I ask somebody, why do you have all these, CLO investments? And they say, oh, well, because they yield higher. And that's the only answer they got. That's a bad answer. But if they say, well, we got it modeled and we look at it and we spread across different investment managers and we do this, we do that, and we've got this monitoring, we will look at, credit, support levels, and we track this and we track that, and we track fair market values, and we don't buy subordinates, we only go as far down as the mezzanine, then that's not a bad answer. But if the only answer they give you is it yields higher, that's not good.
Yeah, good comments. Thank you. Okay, so as promised, I want to make sure folks can get their continuing ed. So have you, or will you in the next 12 months, incorporated new techniques into your regulatory review procedures to address complex asset risks? Yes, you have. No, you have not, or not sure, don't know. We always try to have an out there just in case. So we'll keep this up to allow people time to answer. And maybe I'll just quickly comment. I know I skipped a slide in there, but there's things going on out there that may cause this phenomenon to increase, and there's some things going on out there that may cause it to decrease. Obviously, we have our rising rates, and we have increased regulations occurring. And so those may slow some of the interest in these complex assets. But then on the flip side, I think, companies are maybe getting better at managing the risks and getting more used to this. It's becoming more common. So that may drive continued interest. Okay, so it looks like we have most of our answers here. So I'll turn it back over to Allison.
Thank you, Tricia. Let's see. There we go. A few reminders before we conclude. Please take a moment to complete the attendee survey by following the link in the resource list to the right of your screen. We will respond to all questions via email following today's event. We appreciate you joining us today and thank you for participating in today's program.